All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. Just want to make sure that my sound is coming through okay. Looks like we're good to go there. All right, perfect. All right, so what we like to do with these sessions is take a look at what markets are doing here going into the weekend. We'll recap some of our trades that we've just closed out over the past few days. And then we'll also take a look at a couple of trades that are on our radar for next week. We've got some interesting chart patterns developing going into next week. So I'll walk you through a couple of trades that I am looking at for next week. Let's start out with a look at the overall market big picture. I'd like to start out with this daily chart of SPY. This is the S&P 500 ETF. This is not a chart that I am basing my entry and exit points off of, but it is a chart that I use to help gauge how aggressive or conservative I want to be. Lately, for those of you that have been able to join us for these Wednesday and Friday sessions, I've been talking a lot about credit spreads. I continue to use a lot of them right now, for a couple of reasons. Number one, the volatility is still pretty elevated. We still have the VIX above 20. We're at 2178 here at the moment. We also have a market that's very indecisive. We've got a lot of tug of war going on between the index markets. And the credit spreads are more forgiving type trades. They give you multiple ways of making money on the trades. I feel more comfortable in this environment when you've got so much uncertainty here. I feel more comfortable with the credit spreads. It allows me to control my risk and give myself a higher probability of success over time. So when we look at the daily chart of SPY, we made a new all-time high yesterday. Yesterday on the high, 395.65. That is our new line in the sand on the upside. There's a lot of talk now about SPY potentially hitting 400 before pulling back. Now, whether we get up there or not in the near future, that remains to be seen. But there's some concerns out there. First of all, notice what has happened with volume on this move to the upside. The volume has been really, really good the last couple of weeks. We've been well over 100 million shares traded on SPY on a daily basis. But look what's happened here over the past couple of days. As this market continues to move higher, the volume continues to contract. If we're going to get up to 400, we need to see more conviction out of the volume. I want to see that volume uptick here a bit. If we're going to get a sustainable move up to 400 or even above 400, in my opinion, we need another pullback first. We need a pause. SPY, if you go back a week, you go back into Thursday of last week, we've basically seen a move from 372 all the way up to 395. That's a big move without hardly any pullback. We're overdone on the upside. We're overbought here in the near term. What I would ideally love to see is a pullback next week into the moving averages. We have the 8-period EMA along with the 20-period EMA sitting right down around 388, between 387 and 388. I would love to see us pull back, touch that level before making another run to the upside. That would be a perfect scenario. If we start to break those support levels, the next area below there would be 380, between 381 and 382. That's where the 50-period moving averages are sitting. So that cautiously bullish going into next week. I think you're just respecting price here. If you take a look at the S&P, you take a look at the Dow, they've been super strong here this week. The weak name out of the bunch, and here's where the tug of war kicks in. The weak name is the NASDAQ. The tech stocks have been really, really weak for the last couple of weeks. They've definitely been lagging behind. We have had a couple of rallies this week, but every time we start to see the NASDAQ come to life a bit, it sells right back off. We see all of the rallies sold right now. So now you've got the strength in the Dow competing against the weakness in the NASDAQ. What does that mean for us going into next week? A couple of things. I could certainly see a passing of the baton where you start to see the Dow weaken, the Dow pause, and the NASDAQ try to come to life a bit. Could certainly see some of that sector rotation that we've seen the last couple of years, really. It's very difficult to get the follow through that we ideally want to see if we're not getting all index products in all areas participating. The big news here today is the bond market again. Bond market very, very active. So far, the strength in the Dow has been enough to offset some of the move that we're seeing over in bonds. It'll be very interesting to see what happens next week. Okay, I think it's going to be hard for the market to continue to plow its way higher if bonds continue to stay active like this. I fully realize that they just announced another $2 trillion of stimulus. Obviously, that's going to be baked in, right? I mean, we're going to see an attempt at a rally. We're seeing it here this week. But if bonds continue to stay active like this, again, I think it's going to be difficult for this market to continue on this pace to the upside. The ATR has been very, very good. The average true range down at the bottom of QQQ is up above 8. We saw it a couple of weeks ago back towards the end of February. We saw it down below 5. So we definitely seen the ATR pick up. We've seen the same over on SPY. ATR got up almost to, well, it did pass 6.5 here this week. That is good intraday range, indicating very good intraday movement to work with. The trouble has been we've had a lot of back and forth on many of these individual stocks. There hasn't been a lot of follow through into day 2, 3, 4 on some of these individual stocks. So just something to keep an eye on here going into next week. If you're already in long trades, that's fine. I mean, we continue to see strength here, so you can continue to hold those positions. Are we at levels now where we believe there's favorable risk reward ratios to initiate new long trades? I think that's a stretch. That's why I continue to take a look, and we'll talk about it in just a moment. I continue to take a look at more credit spreads right now. We give up the home run profit potential, but in exchange, we get a much higher probability of success. And I'll walk you through a couple of examples there in just a moment. Now, let's talk through a couple of our overnight pop trades that we closed out here this morning. These were trades that we put on yesterday afternoon. Okay, we put these trades on typically with 30 minutes to go in the session. These are trades that we take going into options expiration. The beauty of Thursday afternoon into Friday is we have all of these individual stocks and ETFs that have weekly options. Those options expire on Friday. So we're very active Thursday afternoon. We actually took 2 trades with our overnight pop trade service. And then we also took 1 trade with our ETF option superstars program. So let's talk about the overnight pop trade service first. And what we did on Tesla. We had talked with our students yesterday. Let me pull up a chart of Tesla and you'll see what I'm talking about here. Tesla has been on a roller coaster ride here of late. We have seen moves in both directions. The latest move has been an impressive rally to the upside. And you can see it right here on the 130-minute chart. We have seen price move from down around 540 or so up to above 700 this week. That's a big move. As a result, we were a little overdone coming into expiration today. I'm not saying Tesla can't head higher going into next week. I'm not concerned with what's going to happen over the next week or two. I'm concerned with what's going to happen over the next 24 hours. So what we did is we came in and we sold an out of the money call spread during the last 30 minutes of the session yesterday. And specifically, we sold the 717.5, 720 call spread. Meaning I'm selling the 717.5 call and I am buying the 720 call at the same time. We sold the spread. Let me get my spreadsheet up here a second. We sold the spread for 60 cents. So we collected $60 per spread on this trade yesterday. It tied up less than $200 of our capital to put the trade on. Okay, so a lot of times people look at Tesla and say, Mike, I can't spend thousands of dollars buying an individual call or put on Tesla. Maybe that's true. But with this call spread here, it allows you to put on a neutral to bearish position with less than a couple $100s of risk. That's pretty attractive. Now, all of a sudden, it's much more doable. The 60 cents that we collected yesterday was the max profit on the trade. That's the most I could have made on the trade. My maximum loss was the $190 per spread. If I was dead wrong and I held all the way to the end of the day today, the most I could have lost was $190. Even on these overnight trades that move against us, in most cases, as you'll see here on the Dow ETF in just a moment, in most cases, we're going to be able to take a partial loss on the trades that move against us. So I love these risk-defined trades because I know it helps me manage my risk, knowing what my maximum loss is right up front before I ever put the trade on. Now, fortunately, that max loss didn't come into play because we were able to close this trade out within the first 5 minutes of the session today. The opening bell rang. We got the closing alert out to our students right away. We closed it out for 12 cents per spread. It gave us a $48 profit per spread which is a 25% return on our capital overnight. We put the trade on 3:30 yesterday afternoon. We closed it out at 9:31 this morning. In and out very, very quickly, 25% return on our capital. That's just a really great position. Now, we could have made money 5 different ways in this trade. We would have made money if the stock moved up, down, or sideways. It didn't matter to us as long as price stayed below 717.5. We also made money from time decay adding up. The beauty of being this close to expiration is the time decay is extreme, right? We benefited from that time decay adding up, and we made money from volatility decreasing. So there was 5 ways of making money on the position. We made money the fastest if Tesla sold off, which is exactly what happened. We're well off the lows today, but the low this morning right at the open was at 666. Okay, we were down over $30 in the session at the open. That allowed us to close out of the spread. Had you held, it would still be a profitable position at this point. Again, we closed it out for 12 cents earlier this morning. It's now trading for 16 cents. So it still has a profit, but like I've talked about here over the last few weeks, with these overnight trades, I like to close them out as quickly as possible on expiration day. Book the profit, free up the capital for the next trade, and not have to stress about watching every little move back and forth throughout the rest of the trading day. So nice trade there on Tesla. The second trade that we put on was on SPY, the S&P 500 ETF. The beauty with this product is it has 3 different expiration cycles every week. We have Monday, Wednesday, and Friday expirations. That gives us 3 opportunities each week for these overnight trades. So Thursday afternoon into Friday, just like Tesla, we looked to sell a call spread. Specifically, we sold a 395, 397 call spread, meaning I'm selling the 395 call and I'm buying the 397 call at the same time. We opened the trade yesterday afternoon, again, right around 3:30. We collected 54 cents or $54 per spread. It was tying up around $150, just under $150 per spread. That was the most I could have lost in the trade. I would have lost money on this trade had SPY moved to the upside first thing this morning. But because we talked about that daily chart, and I can pull up another chart of SPY in just a moment, we've had a heck of a move this week. It's been impressive. We were overdone coming into today. We were looking for either a pause or a pullback first thing this morning. We didn't need a huge move lower. We just needed price to stay below 395. The low of the session, first thing this morning, was at 391.20. That allowed us to close out of the position. First thing this morning, within the first couple of minutes of the session opening, we closed it out for 14 cents. It gave us a $40 profit per spread. That's a 27% return on our capital overnight. Right? We're in and out of these trades very, very quickly. These aren't day trades. We are holding overnight, so you don't have to worry about the pattern day trading rule. But when we're talking about managing this trade in 10 minutes or less and booking a 25, 27% return on our capital overnight, that's powerful. Right? Now, we've had on these overnight pump trades, for those of you that have joined us the last couple of weeks, we've been talking about how well these trades have done for us. We're working on 16 winning trades in a row at this point. Okay, it's been another perfect week this week. Is that pace sustainable? Now, we're going to have some losing trades along the way. It's going to happen. Okay, it's bound to happen. The nice part about these trades is we're able to manage the risk. We're able to keep the risk small. So when the losses do happen, we're going to be able to recover much quicker. All right, so nice trade there on SPY. Again, do we have the home run profit potential? Are these trades going to show you a 500% return overnight? That's not the goal of the trade. The goal of the trade is we're typically seeing between 20 and 40% returns on our capital overnight. That's what we're looking for, and we're perfectly okay with that because we've got such a high probability of success. Going back to last year, with all of the trades that this service has taken, we're up over 77% on our win rate at this point. So it's been a really nice stretch for us. Now, switching on over to the ETF service, we did take an overnight trade with the ETF service as well. And for that one, we used the Dow ETF, symbol DIA. This one has been the strong name out of the bunch here this week. The Dow has been super strong. A lot of that is due to the strength in the financials and the strength in Boeing. Boeing has just been phenomenal this week. It's just been a huge move there in symbol BA. So as a result, we were overbought coming into today. The NASDAQ, the S&P, Tesla, they all opened lower like we just talked about. The Dow did not. The Dow just continues to be super strong here today. So we actually, just before we jumped on our recap session here today, we sent out a closing alert. for this trade. So here's what we did. We sold the 326, 327 and a half call spread yesterday. We sold the 326 call. We bought the 327 and a half call. It was $1.50 spread. We collected 50 cents, right? So we were risking $100 to make 50. Now we would have made money on this trade had price stayed below 326. Currently we're sitting at 327. We're $1 above the strike price of the option that we sold. Bottom line is we did not get the move that we were looking for. We were dead wrong. We didn't get the choppy move this morning. We didn't get the move to the downside. We saw the exact opposite. We saw the move higher. So we had to close this trade out. We closed it out for around 81 cents. It gave me around a $30 loss per spread. So it's never fun taking a loss, right? And no one likes that. But when you take a look at these spreads, we were absolutely dead wrong. We have had hardly a downtick on the Dow all week. And then here today, it's just been off to the races again on the upside. So we did not get the move that we were looking for, and we lost $30 per spread. Okay, so very reasonable. When you talk about a 30, 40% a loss, we can work with that because we know over time the overnight pop trades have given us a 77% win rate. When we have the losses, we can recover much quicker on those trades. And we're just going to continue to look for these here going forward. We'll take a look at another one this afternoon. Friday afternoon for Monday expiration on SPY. We'll take a look to see if we can get one more trade on here yet this week. All right, so DIA was a losing trade there for the ETF service. Matthew, Mike, you're crushing. I just joined the overnight pop trades 2 weeks ago, I think, with the closing trade of Tesla and SPY yesterday. I've already paid for the program. Great stuff, Matthew. I love it. Love to hear it. So well done. We love this back and forth movement. It's interesting because I hear a lot of people talking about markets getting ready to crash, right? I mean, we've had markets just continue to move higher. They're just continuing to pump as much money into the system as possible. Inflation's starting to pick up. I'm hearing a lot of talk about people saying, should we go to the sidelines? Should we get out completely because of what's happening in equities and what's happening in bonds? The beauty here with being active options traders is we can control our risk, right? If we were dead wrong on that Tesla trade, we knew what our maximum loss is. We were going to lose a couple $100 per spread. Worst case scenario. Had we woke up this morning, headlines hit overnight, and we saw an explosive move here this morning in the wrong direction, we know what our maximum loss is. So it doesn't bother me that, there's ever increasing risk market wide of a potential big move coming. That doesn't bother me because I can control the risk along the way. And we really thrive. We love the back and forth movement. We love the volatility. It's good for us as options traders. So again, we know that losses will come. It's part of trading, but yeah, we're just seeing some great price action right now. And all trades you have taken so far have been wins. So good stuff, Matthew. Love to hear it. Keep up the great work. All right. And Cloudly, what is this? So this is our weekly options recap. What we'd like to do in these sessions is walk through some of our recent trades that we've closed out. So I just covered 2 winners and a loss. These are all trades that closed out here today. So we're showing you how we take and manage trades. And then here going forward over the next few minutes, I'm going to walk you through some trades that are setting up for us going into next week. So now you can actually see how we interpret markets, how we identify these trades that we've talked about here so far today. And Kalinka, thanks, Mike. Indeed, super grateful for your trades. So again, appreciate that feedback. Really good stuff, guys. All right, so let's move on over and let's actually talk through some live trade examples. It's fun to recap trades, especially when they're winning trades, right? We love that. But what can we do in real time? What is the market throwing our way here going into next week? The tricky part is, here I'm looking at my other screen. We've got the Dow up 180 points, the Dow futures. The S&P is down 5. The Nasdaq's down 150, and the Russell's up. So we continue to see this massive tug of war going on. Very difficult to interpret what's going to happen next. Are we going to see the strength in the Dow and the Russell win out, and this market continues to head higher? Or are we going to see the weakness in the Nasdaq pull the market lower? Ultimately, no one knows, right? So it's all about managing risk in this type of a market. If we go over to a chart of the Dow, the Dow ETF, symbol DIA, I like to use both the 195-minute and the 130-minute charts. You'll see the 195-minute chart on the left side of my screen, and you'll see the 130-minute chart on the right-hand side. The 130, I've been using the 130 more often here recently, just because these moves back and forth have been so quick. The 130 is going to allow me to react faster. Well, if we zoom into that 130-minute chart, you will notice that price this week, really going back into middle, end of last week, we have gone from 305 all the way up to 327. Right? I mean, we've seen a $20+ move to the upside without hardly a pause. That's very unusual for the Dow. The Dow is only 30 stocks. You don't typically see these types of massive moves like we've seen over the past week. We are overbought going into next week. How do I quantify that? Notice what's happening on our pulse histogram down at the bottom. We've got 4 out of the past 5 bars plotting as yellow. That indicates that price is at an overbought extreme. Price is between a 1 and a 2 standard deviation move on the upside. That's what it means when we see those yellow bars on the pulse. It doesn't mean that price can't head higher. It just means it's not statistically probable. If you're at a 1 standard deviation move here on the upside, we know that only 13% of all occurrences fall outside of this range on the upside. So it's possible, it's just not probable. As a result, when I start to see overbought conditions like this, I am looking for a neutral to bearish trade in the near term. If we look historically, let's take a look at the last couple of cases when we saw those extremes on the pulse. Those extremes actually came on the downside back in January. And we saw another one here just last week. When you start to get those oversold extremes, notice what happened. Price action within a couple of days had bottomed out and reversed in the other direction. That happened back end of January into February. What happened here if we go back to early March? Okay, you take a look, you got yellow bars again on the pulse. What happened? We found support, markets reversed higher. And what's interesting is back on this low right here, if you go back to March 4th, check the headlines back on March 4th. People were writing about, here we go again, there's another big leg to the downside. 2 years in a row, March is just going to get crushed. Here markets wise, lo and behold, as bad as it felt, we got oversold. We had to trust the system. Markets bounced off of that oversold condition. Here we are now with an overbought condition. Everything feels great again, right? We're up near all-time highs. The Fed just continues to do everything in their power to pump markets higher. So it feels like this market's never going to head lower again. We know it's not sustainable to continue to move $20 to the upside every week on the Dow. It's not sustainable. Chances are in the near term, we're probably going to see either a period of consolidation, a sideways move, or a reversal to the downside. It's a very repeatable pattern. We know, again, it's not probable for this move to continue to the upside. Only 13% of all occurrences will fall outside of this range on the upside. As a result, I am going to take a look at a neutral to bearish position going into next week on DIA. Let's go over to the trade page and let's take a look at how we would structure it. Now, looking at the trade page of DIA, we've got all of these different expiration cycles available to us. The yellow expiration cycles are the weeklies and the quarterlies, and then the white options there, those would be the monthlies. Could you trade the weeklies? You certainly could. I would not have a problem with it. Normally, when I trade the weeklies, I'm going out a week or two. I'm going out a few weeks instead of just going out 1 week. Sorry, I guys, trying to turn on. Getting distracted by some alerts here, trying to turn those off. So I like to go out a couple of weeks. The sweet spot for me with a credit spread, in a lot of cases, unless it's an overnight pop trade, I'm typically liking to go out 20 to 40 days. That's typically the window that I'm looking for. So if we go out to April with 35 days left, there's a couple of benefits that we see out in April. The monthly options are going to have the best liquidity, the best volume, best open interest. It makes it easier for us to get fills on trades. If I wanted a neutral to bearish position here on the Dow ETF, I'm going to come to the out of the money calls on the left-hand side. I'm going to go to, price is currently sitting at 327. Let's go to the 330 calls. I'm going to right click on those. I'm going to go to sell and I'm going to go to vertical. right? So it has me selling the 330 call and buying the 335 call at the same time. All right, so there's a $5 difference between those strikes. Ideally, it's easier to structure a trade if you're looking at dollar-wide strikes. We just don't have those available here at this point on DIA. The goal is I want to collect ideally around 30 to 40% of the width of the strikes. So with there being a $5 difference between these strikes, ideally I want to collect between $1.50 and $2. This spread is currently trading for $2.12 mid-price. It does meet my criteria. So if I collect $2.12, it would leave me with a situation where I'm risking $288 to make $212. Slightly worse than risk one to make one. So that would meet my criteria. I like that trade, but let's see if I can make one adjustment. Let's see if I can move those strike prices farther away. The farther away that I get from the current stock price, the higher probability of success I will have on that trade. So if I move the 330 to 335, and then the 335 to 340. Let's see what that does for us. Okay, now it's trading for $1.43 mid-price. Excuse me. So it's a little bit light. I want to ideally get filled around $1.50. Okay, as close to $1.50 as I can get. So let's say markets continue to rally. Wouldn't be surprised at all going into this afternoon if we close near the high of the day. So let's say we can get filled at $1.50 this afternoon. Let's go ahead and take a look at this trade now. So now I don't have $200 of profit potential. I have $150. And I'm risking $350 to make that $150. So I'm slightly worse than risk two to make one. That's a fully acceptable range for me. In most cases, I'm around risk two to make one. All right. Worst case scenario, if I am dead wrong and the Dow does continue to make an outlier move to the upside, the worst case is I'm out $350. I have 5 ways of making money on this position. I make money if the stock moves up, down, or sideways. As long as price stays below 335, I'm okay. I also make money from time decay adding up. Every day that passes, that helps me. And I make money from volatility decreasing. So there's 5 ways of making money on the position. It's a way for me to lean bearish, but with a neutral kicker. Just in case we get that sideways consolidation first, maybe we don't see a washout move lower, I can still make money from a sideways move here. That's why I love this trade versus just buying a long put. Let's just compare this trade to buying a long put. If I come in and try to buy it in the money put option, let's just say we take a look at the 330 put. It's slightly in the money. You're talking about over $900 per contract. That's an expensive contract, right? So I'm able to put on a bearish position with the short call spread for only $350. Very drastic reduction in cost. A lot of times people look at these credit spreads and say, Mike, I think they're too risky. I don't want to take a risky trade like that. But when you compare them side by side, the credit spread is a much safer trade. You have less at risk, less capital required. You have 5 ways of making money versus only having 1 way of making money if you buy the long put. It's going to be a more forgiving trade. So what's the trade-off here? Why not use credit spreads all the time? Some people do. The trade-off is we give up the bigger profit potential. If we buy a long put and the stock moves lower, we're going to make far more capital, far more profit on that long put position. So there is a trade-off there, but in this case, with the market trading the way it is, the credit spreads, in my opinion, are the much better route to go. All right, so that would be a trade on DIA. If we do get filled, let's just say we get filled at $1.50 this afternoon, my target on this trade would be when I can close it out and keep between 50 and 75% of the max profit. So if I can buy this thing back, if I can buy it back for anywhere from, let's just say 75 cents will give me this 50% number. And the reason I'm thinking about it here, guys, is normally I like to target the 75% level. Lately, I've been targeting the 50% level. And some of you have seen that. Some of our customers have seen that. We've been taking smaller profits here lately. And the reason for that, the reason I hesitated, I didn't know if I wanted to cover this today, but I will now that I'm already into it. I'm looking at the 50% level at the moment in many cases because this market has been so back and forth. In order to hit the 75% profit level, you're going to have to hold the trade longer. Again, not a deal breaker. I mean, if the market continues to stay active, you may be able to get to it, but that's going to require a price, to get down around 37 cents or so. So looking for a 50% of max profit number, that would have me creating my closing order immediately for 75 cents. That would give me 50% of my max profit at any point over the next couple of days, next couple of weeks. That would happen the fastest if the stock moved lower. If we got any type of a sell-off on the Dow, we'd be able to make that money, make that profit faster. I've talked about this recently too. I do not like to place these trades midday. Everything I've talked about so far is valid on this trade. I just don't like to place these entry orders until the afternoon, typically between the last 30 and 60 minutes of the session. Between 3 and 3:30 is typically a common time for us to place these entry trades. I like that because it allows me to see if there are any head fakes intraday. It also allows me to take advantage of the bigger volume that comes in towards the end of the day. So this is definitely a trade that's on my radar for later on this afternoon. Just have to wait and see what happens there. And I'm trying to check in. Looks like the NASDAQ is trying to rally higher. It's got a nice little bounce going higher here. So with the NASDAQ moving higher, let's take a look at one more trade here. There's a couple of routes that we could go. We could strictly take a look at QQQ, the NASDAQ ETF. Because it has been beat up, because it has been lagging behind, we could potentially take a look at a trade that would benefit from QQQ moving to the upside. What has happened here over the past week? The NASDAQ has gotten beat up a bit. We got our yellow bars down here on the pulse. We also had some green bars on the pulse indicator. The yellow bars indicate price being between a 1 and a 2 standard deviation move on the downside. The green bars represent price being between a 2 and a 3 standard deviation move on the downside. In other words, we're at a level that's of interest to me because it could potentially lead to a period of consolidation or a bounce higher. Look what's happened since those yellow bars started to plot. Price started to stabilize down here. It hasn't been the cleanest move to the upside. We've had some pretty big moves back and forth, but we have seen a bounce off of the lows. We are still classified as oversold here. The pulse indicator is still yellow. Okay, we could still very well see another push to the upside in the NASDAQ going into next week. Now, based on this chart pattern, would I come in and buy a long call? No. The long call is too aggressive at this point, in my opinion. If you buy a long call, that stock better move higher and it better do so quickly. If it's not a big enough move, if it takes too long, you're in trouble. So looking at another credit spread opportunity, let's come back over here to the trade page. Instead of taking a look at selling a call spread like we did on the Dow, we're going to take a look at selling a put spread on QQQ. Potentially looking for a bounce to the upside. So I'm going to come over to the put options on the right-hand side. And we're going to take a look. Let's go. One of the columns on my trade page here is the probability out of the money column. When I start to structure a credit spread, I typically like to start with the option that has around a 65% chance of closing out of the money. Doesn't guarantee that that's going to be the option that I trade. It's just my starting point. From there, I've got to make sure that I can collect enough premium to make the trade worth my while. So I'm going to right click on the 302 put. It has a 65% chance of closing out of the money. I'm going to go to sell and I'm going to go to vertical. It pops up an order down at the bottom where I am selling the 302 put. I'm going to change my long put from 301 to 300. Okay, there's a $2 difference between those strike prices. I want to collect around 50 cents or higher on the trade. I want to make sure that I am risking between 2 and 3 to make 1. If I can stay inside of that range, the numbers will work in my favor. If I start to risk 4, 5, 6 to make 1, I can't get those numbers to work in my favor long term. That's where most people get into trouble with a credit spread. They go too far out of the money. They start risking 6 or 7 to make 1. Those numbers, you just need an extremely high winning percentage to make that work long term. If you're risking 2 or 3 to make 1, much more doable. So if I get filled, it's trading for 52 cents mid price. Let's say we get filled there this afternoon. We would be risking $148 to make 52. We would make money 5 different ways in this trade. We would make money if the stock moves up, down, or sideways. Doesn't matter to us as long as price stays above 302. That's the strike price of the option that we sold. We also make money from time decay adding up. Regardless of what the stock does, the time decay is going to add up every single day. That's going to help us. And then we also make money from volatility decreasing. If we continue to see the VIX contract, if the NASDAQ starts to kick it in and we still continue to see this market head higher, the volatility will contract and that would cause the options to lose value as well. So 5 ways of making money on the position. We make money the fastest on this trade if the stock moves higher. This is not a trade I would put on right now midday. This is a trade that I would revisit this afternoon during that last 30 to 60 minutes of the session. If we get filled at 52 cents, that's my max profit on the trade. I'm targeting between 50 and 75% of the max profit. So if I can buy it back for between 13 and 26 cents would be acceptable. My initial target normally is at 75% level, but because this market has been so active and so volatile, we're going to go ahead and target the 50% level to start with. So we would look to buy it back for 26 cents. So if you're not already trading the credit spreads, guys, I mean, this market is a perfect example of why the credit spreads can be so powerful. I'm not saying you shouldn't ever buy a call or a put. We absolutely will over time. But these credit spreads are going to be way more forgiving. We've had trades here lately that have been underwater for 10 days at a time. And then all of a sudden you get one reversal in price and that P&L goes from negative to positive immediately. Because even when the trades are moving against us, the time decay is helping us. And it allows us to recover much faster. On the NASDAQ service with our NASDAQ Option Superstars program, we're 24 trades in a row, 24 winning trades in a row. The overnight pop trade service, 16 winning trades in a row. And a lot of those have been, a good majority of them have been with credit spreads. We've been able to navigate through this back and forth movement really, really well. You can put these trades on fully risk defined. These are very safe trades. If you're not using credit spreads, highly, highly recommend that you add those as quickly as possible. You're going to find it far easier to manage your trades over time. Cloudly, you're a new trader. You lost money on gold. All right. So first of all, I'm not saying what you did was wrong on gold. It could have been a perfectly fine trade following a system and just flat out lost. We're going to have losing trades. It's going to be part of trading with any service, with any market. Okay. I mean, we had a loss on the ETF service today with DIA. The key is to keep those losses as small as you possibly can and make sure that you're winning more than you're losing, making sure that you have a good winning percentage over time. Where I see a lot of people making mistakes right now is they're taking way too big of risk. And instead of taking 5 or 6 very small positions, trying to spread that capital into as many areas as possible, they're loading the boat with 1 or 2 positions. And if that one or two, if one of those 2 big positions lose, you're in trouble. Keep that risk small. Okay, you're going to be far better off in the long run. I know it's attractive to say, hey, if I can just hit it big 1 or 2 times, it changes the whole ball game for me. That might be true, but if those 1 or 2 trades lose, you're in trouble. You're potentially looking at a large drawdown, potentially even blowing out an account. We don't want that. These credit spreads, the smaller profits, they can add up in a big way, and you can continue to grow that account size in a more predictable way by keeping that risk small. So if you lost on gold, again, I don't know the reason behind your trade, but if it lost, it's just a losing trade. Move on to the next trade. Try to build your sample set of trades big enough, because over time, if you've got a system that gives you a good winning percentage, the numbers will continue to work in your favor over time. And if you'd like to connect and ask us some questions on how we do things on our side, we'd love to connect and help out in any way that we can. So mike@netpicks.com is my email address. Feel free to reach out anytime. All right. So let's take one more quick peek at markets intraday here. I'm trying to track things on my other screen. I've got multiple monitors here in the office. While I'm speaking, I'm trying to watch things. And you can see, really going back to 11 o'clock, we hit that 11 o'clock reversal. At 11 o'clock, it looked like this chart of SPY. This is the 5-minute chart. I'll make it bigger here. It looked at 11 o'clock like we might break to the downside, might get a little ugly. We found that 11 o'clock reversal, and we've basically been grinding our way higher ever since. So it looks like the S&P trying to fill the gap. And we know how strong Fridays have been for months now. I wouldn't be surprised at all if we rally up and close near the highs of the day. It's just been a very repeatable pattern here so far this year. So we'll track that going into this afternoon. And I'm looking to get a few new trades on during that last hour of the day. Can I check a chart of Bitcoin? I actually don't have a chart of Bitcoin up. I don't trade Bitcoin myself personally. So here's the problem that I have with Bitcoin, guys. If you're just trading Bitcoin directly, I'm not saying you shouldn't. The problem with Bitcoin is you can only play it from the upside, right? You're limited to buying Bitcoin. So, it's tricky because your options aren't as wide as what you can do on the option side. For me as a trader, I want to have the ability to play the markets higher and lower. I want that flexibility. Bitcoin doesn't give me that flexibility. If you want to, just view it as a long-term investment, buy and hold, that's one thing. But for me, that's just not what I do. I'm an active trader. I like to play things back and forth. So Bitcoin, I'm probably one of the exceptions. I just don't trade it. I don't do very much with it. Not saying I won't ever, as they come out with some additional products that give us more flexibility to play the moves higher and lower. That's a different story. But for the time being, I just don't do much with it. It's had a heck of a move. I mean, what is Bitcoin up? I have a quote. I don't have a chart up. Was it 57,000 last time I saw it? So yeah, it's been an incredible move higher with Bitcoin. Just like I said a few moments ago, just keep the risk small, right? Crazy things have happened in Bitcoin the last year as well. We've seen some very big movement in price. So just keep the risk small. That goes for any product that you're trading. Focus on that long-term picture and you'll be much better off. I mean, in my opinion, Bitcoin's pretty overdone in the near term, but again, I'm not trading it on a regular basis. So I don't track the technicals very closely on that one. So sorry about that, Umesh. I just don't trade Bitcoin myself. All right, guys, I'm going to start to wrap it up here for today. If you have any other questions on symbols I have not taken a look at, go ahead and type those in now. Otherwise, I will be back next week. Our next session would be on Wednesday. So we'll be back on Wednesday at 12 o'clock, and we'll take a look at what the market has done at that point to start the week. So if you have any questions between now and then, feel free to email me directly, mike@netpicks.com. Otherwise, enjoy your weekend, everybody, and we'll talk to you guys here next week for our next live webinar.